Silver's next price level. Now, triple digits breached, institutional money quietly repositioning, and yet, most observers are celebrating exactly when they should be calculating. The metal crossed a threshold that took decades to reach. But here's what the data isn't saying out loud. Every major breakout in silver's history has been followed by a phase that separates strategic holders from emotional participants. Right now, the next price level isn't just a number on a chart, it's a decision point, and the window to position correctly is narrower than it appears. Welcome to Silver Collapse Coming. If you've built wealth over decades, you understand that the most valuable insights rarely come with fanfare. This channel exists for that reason. We'd be honored if you'd subscribe. Not because we need the numbers, but because serious economic analysis deserves serious attention. And one more thing, drop a comment below and let us know, where in the world are you watching this from? We're building a community of strategic thinkers, and we want to know where sound judgment still resides. Now, let's examine what this price level actually means. Silver crossed $100 per ounce, not in a flash, not in a speculative frenzy that disappeared by morning, but in a sustained move that held its ground. For decades, that number existed only in projections, in analyst reports filed away and forgotten, in conversations among precious metals, strategists who wondered if they would live to see it. Now it has arrived. But here is what separates the prepared from the surprised. This is not simply a price milestone. This is a structural repricing, a moment when the market collectively decides that the old assumptions no longer apply. When silver sat at $50, it was still possible to dismiss the rally as temporary, as a reaction to short-term disruptions or speculative enthusiasm. At 70, the skeptics began questioning their positions. At 100, the question shifted entirely. The question is no longer whether silver belongs in triple digits. The question now is, how much higher does the repricing go, and who will still be holding exposure when the next phase begins? Institutional observers have been watching something that retail participants often overlook: volume. Not just the amount of contracts traded, but who is trading them. When a breakout occurs on thin volume, driven primarily by leveraged futures positions, it can reverse as quickly as it began. But when a breakout is accompanied by deep participation, when physical demand shows up alongside paper speculation, when buyers step in aggressively on every minor pullback, that is a different structure entirely. And right now, the data suggests the latter. Silver is not being pushed higher by a single class of speculator. It is being pulled higher by converging forces. On one side, monetary anxiety. Investors who once viewed silver purely as an industrial metal are now reconsidering its role as a store of value, a hedge against currency instability, a tangible asset in a world where confidence in paper systems is quietly eroding. On the other side, industrial demand that refuses to weaken. Solar panels, electric vehicles, defense systems, technology infrastructure, all of these sectors require silver, and unlike gold, which can be substituted or avoided in many applications, silver's unique properties make it irreplaceable in critical industries. When monetary demand and industrial demand collide in the same asset, the result is not a typical rally, it is a squeeze. But here is where most market participants make a critical error. They confuse a strong conviction in silver's long-term fundamentals with a justification for ignoring position size. Belief is not a risk management strategy. An investor might be entirely correct that silver is heading toward $130, $150, or higher. But if their exposure becomes so large that a single violent shakeout forces them to sell at the worst possible moment, then being right on direction becomes irrelevant. This is why professional capital allocators think in layers. The first layer, the core position, represents the investor's long-term thesis. This is the portion that remains untouched unless the fundamental story breaks. It is the allocation that survives pullbacks, corrections, and temporary panic. The second layer, the tactical position, is designed to be trimmed during euphoria and rebuilt during fear. This is where discipline replaces emotion. When silver rallies into extreme momentum readings, when retail enthusiasm reaches fever pitch, when everyone is celebrating, that is when the tactical layer is reduced. Not because the thesis is wrong, but because the mathematics of exposure have changed. The third layer, the trade position, is designed for short-term volatility. It allows an investor to participate in rapid moves without risking core conviction. It provides psychological relief, the feeling of taking action, without dismantling the strategic foundation. And here's the uncomfortable truth that separates amateurs from professionals. Most investors never think about position drift. They build a silver allocation when the metal is at $50, perhaps 10% of their total portfolio. Silver doubles to 100, the rest of their portfolio remains flat. Suddenly, without making a single decision, their silver exposure is now 20%. They did nothing. The market did everything. And now they are carrying twice the risk they intended. not because of conviction, but because of mathematics. This is not strategic positioning. This is accidental gambling. And when the inevitable pullback arrives, even if temporary, the emotional weight of an oversized position forces irrational decisions. So the first principle in navigating silver's next price level is simple. Understand what you own, understand why you own it, and understand that exposure must be managed, not celebrated, because the market has a way of punishing the overconfident, regardless of whether their thesis is ultimately proven correct. And right now, with silver in triple digits and momentum still building, the room for error is smaller than it appears. There's a pattern that repeats itself in every major commodity rally. The breakout happens, the crowd celebrates, and then, without warning, the market does something that makes no sense to those who are watching price alone. It pulls back violently, not because the fundamentals changed, not because the thesis broke, but because the market needed to remove the weakest hands before the next phase could begin. Silver has a particularly brutal reputation for this behavior. It rewards patience and punishes greed. It climbs steadily for weeks, then it races half the gains in 48 hours, then resumes the uptrend as if nothing happened. And every time, the same investors make the same mistake. They buy at the top of the euphoria, they panic at the bottom of the shakeout, and they exit right before the rally continues. So the question professionals are asking right now is not whether silver can go higher. The question is, how sustainable is this momentum? And the answer lies in understanding what is driving the move. There are two types of buying in commodity markets. The first type is speculative. Traders using leverage, chasing short-term price action, entering positions because the chart looks strong. This type of buying can create explosive moves, but it can also disappear overnight. When leveraged positions become overcrowded, when margin calls begin, when sentiment shifts, the selling can be just as violent as the buying. The second type is structural. Long-term allocators taking physical delivery, industrial users securing supply months in advance, institutions building positions slowly, absorbing dips rather than chasing breakouts. This type of buying does not create fireworks, but it creates foundations. Right now, the evidence suggests silver's rally is being supported by the second type more than the first. Every time the metal dips, even by a few dollars, buyers step in quickly. The price does not collapse, it does not spiral into panic, it stabilizes, and then resumes climbing. That behavior reveals depth. It reveals that there is real demand sitting beneath the current price, waiting to absorb supply. And that is very different from a purely speculative rally, where a single piece of bad news can trigger an avalanche. But here's where technical indicators become useful, not as crystal balls, not as guarantees, but as measuring tools for momentum and exhaustion. When the relative strength index climbs into extreme overbought territory, above 70 or 75, it does not mean silver must crash immediately. It means the odds of a sharp pullback have increased. And more importantly, it means the next correction is likely to be faster and deeper than the gentle dips traders have grown accustomed to. Volume patterns matter just as much. A breakout, accompanied by record volume, with participation across futures, physical, and equity markets, that is confirmation. A breakout on declining volume, driven by a small number of large trades, that is a warning. And then there is the most important question of all. Who is buying? If the rally is driven primarily by retail investors, by individual traders chasing headlines, then the foundation is weak. Retail investors are emotional. They buy at the top, they sell at the bottom, they provide liquidity to professionals who are doing the opposite. But if the rally is driven by sovereign funds, by central banks quietly accumulating, by corporations locking in supply contracts, then the foundation is strong. These entities do not panic. They do not check their portfolios every hour. They build positions over months, even years. Right now, the macro backdrop is reinforcing the structural demand story. The US dollar index sits in the mid-90s, not collapsing, not in free fall, but weaker than it has been, and more importantly, weaker than policymakers seem concerned about. That shift matters. For years, a strong dollar was treated as non-negotiable, as a symbol of American economic dominance. But when that narrative softens, when authorities signal they are willing to tolerate a weaker currency in exchange for other policy goals, commodity markets respond. Because a weaker dollar is not just a technical phenomenon. It is permission. Permission for gold to rise. Permission for silver to rise. Permission for hard assets to reprice without immediate intervention. And once that permission is granted, capital begins to flow accordingly. But permission can be revoked. Central banks can change their tone. Policy can shift overnight. And that is why professionals never assume the current environment is permanent. They prepare for two scenarios simultaneously. The scenario where silver continues grinding higher, breaking through 110, 120, and 130. And the scenario where momentum breaks, where the first real pullback turns into something deeper and tests whether the structural buyers will defend lower levels. The investors who survive both scenarios are the ones who trim into strength, who take profits when the market is euphoric, who reduce exposure when their position has grown beyond their original plan, not because they have lost faith, but because they understand that preservation comes before maximization. And right now, with silver in triple digits and technical indicators stretched, the professionals are not asking if they should trim, they are asking how much. There's a question that surfaces every time silver rallies, a question asked by investors who watch the metal climb, who feel vindicated in their thesis, but who cannot understand why their portfolios are not reflecting the same gains. The question is simple. If silver is up, why are silver stocks not exploding higher? And the answer, uncomfortable as it may be, reveals the difference between theory and reality. Silver mining companies are not pure plays on the metal, they are businesses. And like all businesses, they are exposed to costs, management decisions, political risk, operational failures, and capital structure. An investor who buys physical silver owns the metal. Nothing more, nothing less. The price of silver is the only variable that matters, but an investor who buys a silver mining stock owns a claim on future cash flows, generated by a company that must extract metal from the ground, refine it, transport it, and sell it, all while managing labor disputes, energy costs, environmental regulations, permitting delays, and financing needs. These variables do not move in lockstep with the silver price. Sometimes they move in opposition. This is why some mining companies can underperform even during a metal bull market, because while silver is rising, diesel fuel might also be rising, labor costs might be rising, permitting timelines might be extending, and if management responds by issuing new shares to raise capital, diluting existing shareholders in the process, then the stock price can fall, even as the underlying metal climbs. This is not a flaw in the thesis. It is a reminder that mining equities are a different asset class entirely. So the investors who succeed in this space are the ones who do not treat all silver stocks as equals. They screen, they analyze share structure, they track insider ownership, they evaluate management's history with capital allocation, because in a bull market, every mining stock will get some attention, but only a few will deliver the leverage that investors are seeking. The rest will dilute, disappoint, and destroy capital. Here's what separates a quality mining stock from a mediocre one. First, share structure. If insiders own a meaningful percentage of the company, and they are not selling, that signals alignment. If institutional investors with long time horizons are accumulating quietly, that signals credibility. But if the float is bloated, if shares outstanding keep rising every quarter, if management treats equity like an ATM machine, then the stock is not an investment. It is a transfer of wealth from shareholders to executives. Second, jurisdiction. A silver deposit in a stable mining district with existing infrastructure, roads, power, water, skilled labor, that deposit is worth more than a higher grade deposit in a region with political instability, corruption, or hostility toward foreign capital. Because the path to production matters more than the size of the resource. A mediocre project in Nevada can be more valuable than a world-class project in a jurisdiction where permits take a decade and expropriation is a constant risk. Third, accretive acquisitions. The best mining companies do not just drill, they acquire. They buy producing assets at discounts during downturns. They integrate those assets efficiently, and when the next bull market arrives, the cash flow from those acquisitions funds expansion without requiring equity raises. But here's the trap that catches even experienced investors. They confuse diversification with safety. They buy a basket of 10 or 15 junior miners, assuming that if a few succeed, the portfolio will perform well. But junior miners are not like stocks in other industries. One catastrophic failure, a management fraud, a geological disappointment, a financing collapse, that stock does not just underperform, it goes to zero. And if 3 or 4 positions in a 15-stock portfolio go to zero, the remaining winners must deliver extraordinary returns just to break even. This is why many professional allocators prefer a different approach. They hold a small number of carefully researched individual names, and they balance that concentration with exposure to diversified mining ETFs. The ETFs will never deliver 10 times returns, but they also will not deliver total losses. They provide participation, stability, and liquidity. Now, while silver has been capturing attention, gold has been conducting its own quiet revolution. Gold is no longer flirting with $5,000. It has surpassed it. Some sessions have seen gold trade above $5,200 per ounce. And the institutions that manage billions in capital are not treating this as a speculative move. They are treating it as a repricing of risk itself. Gold does not rally because investors are optimistic. Gold rallies because investors are uncertain, not panicked, not fleeing into bunkers, but uncertain about the long-term stability of currencies. about the trajectory of debt, about the willingness of governments to prioritize fiscal responsibility over political survival. And when that uncertainty becomes widespread, when it moves from the fringes into the mainstream, gold stops being a hedge. It becomes a core holding. Central banks understood this years ago. That is why their accumulation of gold has been steady, persistent, and largely unreported in daily financial media. They are not buying gold because they expect a crisis next month. They are buying gold because they expect gradual devaluation over the next decade. And now, even technology companies, firms built on digital innovation, are beginning to hold physical gold in reserve, not as a novelty, not as a publicity stunt, but as a recognition that even in a high-tech world, physical settlement still carries weight. So the investors who are positioning correctly right now are not choosing between silver and gold. They are holding both, because the forces driving these metals higher are not temporary. They are structural, and structures do not collapse overnight. They erode slowly until one day the foundation gives way. There are moments in financial markets when everyone is watching the same event, when trading floors go quiet, when screens fill with live feeds, when the outcome of a single announcement can move billions of dollars in minutes. Today is one of those moments. The Federal Reserve concludes its two-day policy meeting. At 2 o'clock Eastern Time, the statement is released. At 2:30, the press conference begins, and the world waits, not because anyone expects a rate change. The market is already priced in a hold, but because the words matter more than the decision. The tone matters. The body language matters. And most importantly, the signal matters. Central banks operate in a space where perception becomes reality. If the chairman sounds cautious, even without changing policy, markets interpret caution as a precursor to easing. If he sounds firm, even while leaving rates unchanged, markets interpret firmness as a commitment to higher for longer. And right now, the Federal Reserve finds itself in an uncomfortable position. On one side, political pressure. Leaders who prefer lower rates, who want cheaper borrowing costs, who see monetary easing as a tool for economic growth and asset appreciation. On the other side, credibility. The institutional need to be seen as independent, as data-driven, as immune to short-term political influence. This tension creates volatility, not just in interest rates, but in everything priced relative to the dollar, to inflation expectations, to risk appetite. Gold and silver are not exempt from this volatility. They are central to it. Here is what professional allocators are watching in the hours after the Fed speaks. Not the initial move. The initial move is almost always a trap. If metals sell off sharply immediately after the statement, that does not signal weakness. It signals that leveraged positions are being flushed. But if those same metals recover within hours, if they reclaim lost ground and push higher by the end of the session, that is strength. That is absorption. That is evidence that real buyers are waiting beneath the surface, ready to take advantage of temporary panic. Conversely, if metals rally initially on dovish language, but then fail to hold gains, if they drift lower over the following days, that is a warning. It suggests the move was driven by speculation, not conviction. And while the Fed commands attention today, there are other forces quietly reshaping commodity markets. Oil is back in focus. West Texas. Intermediate crude is trading in the low 60s. Brent crude sits in the high 60s. This matters because energy is a tax on everything. Mining companies burn diesel to operate equipment. Refineries consume electricity to process ore. Transportation networks require fuel to move product. When energy costs rise, mining margins compress. When energy costs rise while metals are also rising, the question becomes whether metal prices are climbing fast enough to offset operational expense increases. Right now, oil is stable but elevated, not crashing, not spiking, just high enough to remain a factor in every cost calculation. On the bond side, the 10-year Treasury yield hovers in the mid 4% range, not collapsing into deflationary territory, not surging into panic, just elevated enough to create competition for capital. In a world where risk-free government bonds yield over 4%, hard assets must offer something bonds cannot. And what they offer is protection. Protection against currency erosion. Protection against policy mistakes. Protection against the slow grind of purchasing power loss that official inflation statistics rarely capture. But here is where the story expands beyond gold and silver, because the next phase of commodity investing will not be driven solely by precious metals. It will be driven by materials that governments designate as strategic: antimony, tungsten, rare earth elements. These are not household names, but they are critical inputs for defense systems, for renewable energy infrastructure, for advanced manufacturing. And when a government labels a material as strategic, everything changes. Permitting timelines accelerate. Funding becomes available. Acquisition interest intensifies. The challenge for investors is distinguishing between genuine opportunities and promotional schemes, because in every commodity bull market, Exploration companies multiply. Press releases flood inboxes. Presentation decks promise world-class deposits. But most of these companies will never produce a single ounce of anything. They will raise capital, drill a few holes, issue optimistic updates, and eventually fade into obscurity. The companies that succeed are the ones with three characteristics. First, cash. A junior explorer with no funding is not a business. It is a financing vehicle waiting to dilute shareholders. Second, a clear path to production, not just a large resource estimate, but infrastructure access, but political support, metallurgical simplicity. Third, management with a track record. Teams that have built mines before, teams that understand how to navigate permitting, financing, and operational risk. Platinum and palladium represent another category entirely. These metals are industrial, cyclical, boring, until they are not. For years, they have underperformed. Prices collapsed. Investor interest evaporated. But that is precisely when opportunities emerge, because when everyone stops paying attention, valuations reset. And when one catalyst appears, one supply disruption, one policy shift, one demand surprise, the entire complex can reprice violently. So here is the strategic framework for navigating this environment. Do not confuse a strong year with a sound process. Many investors will generate exceptional returns in 2026 simply by taking excessive risk. That does not make them skilled. It makes them lucky. Until it does not, manage exposure mathematically. Trim positions that have grown beyond intended allocations. Keep capital available for pullbacks. And remember, the market rewards those who survive long enough to benefit from the full cycle, not those who maximize gains in a single quarter, only to lose everything in the next. The final question is simple. Are you positioned for the metal itself, or for the leverage in the miners? Because those are two different strategies, and mismatching personality with approach guarantees failure. Right now, with silver in triple digits, with gold above 5,000, with central banks navigating impossible trade-offs, the opportunity is undeniable, but so is the risk. And only those who respect both will be standing when this cycle completes.